Welcome to the deep dive. Today, we're taking a deep breath and plunging into something that really is the engine of the global economy. We're talking about the financing of small and medium-sized enterprises, SMEs, and the, the absolutely crucial role of microfinance.
And this is such a necessary deep dive because these sectors, they often fly under the radar, but they're completely foundational. I mean, SMEs are the economic backbone, full stop. They're responsible for most of the employment, the innovation, the income generation in almost every country you can think of.
Right.
And then microfinance serves those micro-entrepreneurs, the low-income communities who, desperately need capital, but are just totally locked out of traditional banking.
And that locked out feeling has been, it's been universal historically. If you're a small business owner, it doesn't matter if you're running a tech startup in London or a small food stall in Mumbai. You face these massive structural barriers.
Yeah, you probably lack the standard collateral that banks demand.
Exactly. Your financial history might be informal or just too short, and so lenders just look at you and see an unacceptably high risk.
It just creates this tremendous bottleneck for growth. It's simple, really. If capital can't flow to the innovators and the small businesses, the whole economy suffers. So I think our mission today is to systematically unpack how digital finance and the rise of FinTech has completely flipped that script.
Okay.
We're going to look at the global sources and see, exactly how technology is using data to lower costs and, crucially, letting lenders assess risk with surgical precision, whether that's in New York, Nairobi, or New Delhi.
Okay, so let's start where financial systems have been, I guess you could say, the most rigid, the United States. Traditionally, getting an SME loan meant, dealing with a bank or a credit union, and the whole process was just slow.
Painfully slow, and it often depended heavily on the government acting as a sort of safety net.
Right, the SBA.
That's right. The Small Business Administration, they've always been central. They run programs, the most famous being the 7A scheme, which is essentially a loan guarantee.
Yeah.
The government agrees to absorb a percentage of the loss if the business defaults.
Which makes the private lender feel a lot safer.
It reduces their risk, exactly. It provides stability, but it certainly doesn't provide speed.
And speed is exactly what the fintech revolution delivered. Platforms like Cabbage, OnDeck, Bluevine, they didn't just digitize the paperwork. They completely re-engineered the trust model. They looked at the process and said, why wait weeks?
Weeks or months?
Right, for some retrospective financial report when we can look at the business operating in real time.
The change is, it's transformative. Instead of focusing on historical assets or, collateral,
Sure.
they instantly pull and analyze verifiable dynamic data.
Like what specifically?
Real-time sales flows from their point-of-sale systems, accounting records, payroll info, even, online customer reviews or their e-commerce activity. And the result, as you said, is a loan decision in hours, not months.
And that focus on cash flow is such a crucial pivot. Conceptually, right, if a business consistently has, say, $5,000 flowing through its register every single day, that's a powerful signal.
It's a huge signal of repayment capacity regardless of how much physical collateral they actually own.
Yeah.
And that cash flow-based approach is also fundamental to U.S. microfinance, which often relies on community development financial institutions or CDFIs.
And what are those exactly?
They're mission-driven lenders, often nonprofits. They support very early-stage entrepreneurs, sole traders, businesses in low-income or minority communities.
The ones who get rejected outright by the big banks.
Almost always, yes.
Uh-huh.
And they combine that digital cash flow analysis with relationship-based lending. So the human element is still there, providing mentorship and deeper context on the business.
Okay, so let's shift across the Atlantic. The UK, we see a similar disruption, but it seems like it's been accelerated by regulation there. You've still got the powerful high street banks, but fintechs like Funding Circle and Tide have become essential.
Yes. And it's probably worth clarifying some of the products they offer. You hear terms like working capital and revolving credit. Working capital is basically short-term funding. You need it to cover immediate operational costs, like buying inventory or making payroll.
Right. And revolving credit.
That acts more like a flexible business credit card. Unlike a fixed loan, you just borrow what you need, you pay it back, and then the credit line replenishes itself.
That makes sense. So what gives the UK a unique edge in assessing the risk for those kinds of products?
2 words: open banking. This is a complete game changer. It's a regulatory framework that, with the customer's permission, of course, allows verified third parties, like lenders, secure access to a customer's bank transaction data.
And we're not just talking about a summary.
No, not at all. This is the verified line-by-line transaction history. For a lender, this immediately strengthens their affordability assessments. They can see exactly where the money comes from and where it goes.
So in the U.S., the government was guaranteeing the loan after the fact. Here, the government is enabling the infrastructure open banking that makes the lending decision safer in the first place.
Precisely. And that digital infrastructure, it proved invaluable during recent economic stresses. It allowed the government to distribute recovery loan schemes much faster and more intelligently than was possible in, any previous crisis.
So while the West was refining its existing structures, emerging markets, they were often starting with a blank slate. This led to what some people are calling a total financial revolution. The need was just so much greater.
That is the perfect way to frame it. Look in India. It has one of the world's largest SME populations, but so many of these firms operate completely informally. They're outside the traditional banking system.
Hmm.
And that results in a massive, fundamental financing gap.
So if there are no balance sheets, how on earth do digital lenders assess risk? What data could they possibly use?
They dive deep into alternative data sources, things that are pretty unique to India's advanced digital public infrastructure.
Hmm.
For example, lenders look at GST filings. That's the goods and services tax. It provides a real-time ledger of a business's scale and activity.
Okay.
But even more critically, they analyze UPI transaction flows.
UPI, that's India's unified payments interface, right? The real-time payment system that's been so successful.
Hugely successful, exactly. Every transaction, from a customer paying a street vendor to a business paying a supplier, it often goes through UPI. By analyzing these high-frequency real-time flows, alongside e-commerce sales, inventory data, digital lenders can issue an SME loan in hours based solely on proven cash flow.
So they completely circumvent the need for physical collateral.
Entirely.
That instantaneous shift from collateral to transactional data, that feels like the single defining feature of this whole global transformation.
It is. And you see similar innovations in India's microfinance sector. It heavily supports women entrepreneurs, rural households. They often keep the traditional strength of group lending models where you have joint liability.
So everyone in the group is responsible.
Yes, which encourages repayment discipline. But now they use mobile wallets for rapid, low-cost collection and disbursement.
The contrast with China here is fascinating. India's digital lending grew up, sort of decentralized, but China's is highly centralized, integrated. Platforms like Ant Group, which operate these massive payment and e-commerce services, they just dominate.
So what's the key difference when the lending platform is the marketplace?
I'm guessing. Control?
Total control. Ant Group assesses the creditworthiness of the small merchants operating within its ecosystem. They use real-time behavioral, transactional, even supply chain data. They know your sales volume, how quickly you fulfill orders, your customer service ratings, everything.
And because they control the data.
They can offer instant working capital loans or merchant cash advances seamlessly. It's lending embedded right at the point of need.
Okay, now let's move to Africa, where we see the unique power of mobile money. In many places, that's the foundational financial infrastructure, right?
It's a textbook example of innovation born from necessity. Formal records are scarce, so cash flow lending is the rule, not the exception. And the data sources are, well, they can be surprising. Digital lenders analyze mobile money transaction flows, merchant payment patterns, sure. But they also look at things like airtime purchases.
Airtime purchases. How does buying cell phone minutes tell you anything about credit risk?
It's a key behavioral signal in cash-driven economies. Consistent, regular airtime purchases, even small ones, they demonstrate a steady, predictable cash flow and reliability. If a borrower is making regular payments on something as essential as connectivity, it provides a really important data point when formal credit history just doesn't exist.
Wow. And that mobile infrastructure, it lets microfinance expand incredibly quickly, using mobile wallets for disbursement and repayment.
Right, pulling money directly from the borrower's mobile account.
Yeah.
It dramatically boosts financial inclusion.
And finally, Latin America. We see that same integration model, driven by huge regional platforms. Companies like Nubank in Brazil or Mercado Pago, which is massive in e-commerce and payments.
Yes, and they're doing the same thing, weaving lending directly into their ecosystems. They leverage existing transaction histories, detailed customer behavior from their payment and digital banking arms, and they use that to address the region's traditional credit problems for small businesses.
So if we connect all these global examples, the unifying theme is this fundamental and probably permanent shift. We're moving away from traditional backward-looking underwriting toward What? A real-time financial health assessment.
Absolutely. The tech allows lenders to move past the traditional headache of verifying financial statements. The question is no longer, what did your business earn last year? It's, what is your business earning right now, and what does the data suggest about next month?
So how exactly are they confirming that current performance without the paper trail?
They use verifiable digital signals. They integrate directly into the tools the businesses are already using every day. Data is automatically pulled from digital invoicing platforms, inventory management systems, point-of-sale systems. It provides these real-time, objective signals of business health.
And repayment has also completely changed. We're moving away from that rigid, fixed monthly payment.
Yes, and this is where the technology enforces discipline while also aligning with the business's reality. And that brings us directly to the merchant cash advance model, the MCA. It's a brilliant innovation in aligning risk.
Okay, so break that down for us.
Instead of a fixed monthly payment of, let's say, $1,000, the lender deducts a pre-agreed percentage, maybe 10% of the business's daily revenue, until the loan is paid off.
That makes immediate sense. So if my toffee shop has a fantastic sales day, I pay off more of the loan. But if I have a slow Monday, the repayment is smaller, which means I don't face a sudden cash crunch.
Exactly. The repayment structure is married to your actual business performance. It smooths out the risk for both sides. And with this massive data flow we've been talking about, lenders are now using AI and behavioral analytics to predict stress signals early.
So they're not waiting for a missed payment anymore.
No, the algorithms are flagging deviations the moment they happen. For an SME, this might be a sudden drop in vendor payments. For a micro-entrepreneur, it could be inconsistent airtime top-ups. The lenders can then intervene proactively, offer a short-term deferral, maybe restructure the loan, before the whole thing escalates to an irreversible default.
Looking ahead, where does this hyper-digital model take us? It almost sounds like we're moving toward a world where credit is, I don't know, invisible.
We are definitely moving toward what's called embedded finance. Credit delivered seamlessly, invisibly, right inside the business management tools themselves. Imagine you're running payroll, and your accounting software automatically suggests a temporary line of credit to cover the gap before a big invoice gets paid.
And the regulatory side is catching up too, I imagine. Things like tokenized assets, digital identity systems, that could streamline collateral registration and verification even more, especially in markets still reliant on paper.
Precisely. And this raises a really important point. As real-time payments become the global norm, these lending models will become incredibly dynamic. They'll adjust credit amounts and pricing daily or maybe even hourly based on constantly updated cash flow patterns. The fixed, static loan agreement will increasingly become a relic of the past.
What a profound re-engineering of the global financial system we've just covered. I mean, digital technology has bypassed decades of structural problems, transforming credit access and truly supporting entrepreneurship and innovation from the U.S. to Africa.
The core conclusion is really this. Technology has solved the knowledge gap. That gap was the main driver of perceived risk. By using previously ignored data, whether it's GST filings, supply chain records, or even personal airtime purchases, credit is now cheaper, faster, and accessible to billions more people.
And that leads us to our final provocative thought for you, the listener. Our whole discussion has highlighted that creditworthiness is now an active, ongoing thing. It's determined not by a paper file, but by real-time transaction data and continuous behavioral patterns. So if access to capital is now defined by this comprehensive digital footprint, your financial health being analyzed with every transaction, how must you, as an entrepreneur or an individual, adjust your interaction with the digital economy to ensure you are proactively building a positive, accessible digital financial record for your future?
That's certainly something to consider as this all expands. Thank you for joining us for this deep dive.
We'll catch you next time.